Greetings. What I want to do in this short video here is start what will be a series of videos making up for the one class that was missed due to the absence of the TA, the teaching assistants, on that day of the quiz, you'll recall. So it makes sense that we do need some video sessions to make up for that. And this will extend what we started yesterday, May 11th, when we were doing foreign currency accounting and transactions of foreign currencies. This particular situation is we have a consolidated company, and in the consolidated company, the parent is a U.S. company reporting in U.S. dollars, and one of its subsidiaries is a foreign corporation reporting in foreign currency. And what we have to do is we have to translate, or we have to the better word to use for this conversation, so our words are exact, is we have to convert the foreign subsidiaries reporting their financial statement, that is in foreign currency. We have to, I want to use the word convert, we have to convert the foreign currency of the subsidiary into the reporting dollars on the parent's financial statement, which will be U.S. dollars. So the reason we call it reporting dollars is that's the financial statement is going to go to the SEC, the New York Stock Exchange, shareholders, all U.S. based. It's a U.S. corporation. It reports in U.S. dollars, so we'll refer to that as the reporting currency. And our job is to take the foreign currency on the subsidiaries books over here and convert it into U.S. dollars. So I'm going to give you what my theory of how to look at translation versus remeasurement. I looked in textbooks, I looked in a couple different places, and I didn't find anything satisfactory. To me, you might find it satisfactory. You might come up with your own way of looking at the theory of the accounting of why we do it one way versus the other way, and in which situation it occurs. I did see in one source, one textbook, that the author wrote, in their opinion, there's no one satisfying way to describe the accounting theory here. So it stands to reason that you need to just maybe take what I say, maybe do some reading on your own and think about it on your own as to come up with a way to conceptualize it. Nevertheless, I'll share you my way of looking at it, and it goes like this. If we were to say to ourselves, all right, here's our situation. We have a U.S. parent company over here. They have to consolidate a foreign corporation, and the foreign corporation is reporting in some foreign currency. We'll call it we'll make a symbol for it like that. There, I don't know what that is, but we'll make a symbol. So what we now have is we have a situation where this needs to be converted into U.S. dollars because we're going to put it on and report it on a financial statement that's reporting in U.S. dollars. So you might say, well, how am I going to do this conversion? What rates of exchange on the exchange market should I use? And the most common thought would be, oh, the date of this financial statement is 12/31/16. So what was the spot rate? What was the foreign currency exchange at that date? And then just convert everything based on that rate, the spot rate of that day. That's the date of the balance sheet. That's the date of the income statement, and just do it. Why ask questions further than that? And I would say that makes sense. So I would be saying that in the normal course of the world, that's exactly what I would do. No questions asked, I'm done. Just whatever it was. Well, that works pretty good for the balance sheet. The income statement transactions occurred on different days of the year, and you might come up and say what we said in class yesterday, well, let's just use an average for the year, average for that year, and we're done. And indeed, what we just described is what is known as the translation methodology. Sort of straightforward. So we just described using the balance sheet rates, the average rate for the income statement, the exchange rates on the balance sheet date, and the average rates for the year as our method of converting from the foreign currency to U.S. reporting currency. So that's straightforward, makes the most sense, logical, done. And that is the theory that you apply when you have the following situation. When you have a parent corporation, U.S., owning a foreign corporation here, that is self-contained. It runs itself, it has its own management, it's incorporated overseas, it deals in the currency they report in as being their functional currency, where we defined functional yesterday as being, that's how they do business. That's how they function. So their functional currency is the currency that they're giving us on their financial statement. It's the normal expectation of what a parent would be in the U.S. with a foreign subsidiary in another country. They're doing business there. They're reporting their transactions in the currency they do business with, how they function, the currency they function with. End of story. So we go back and say, all right, translate it. And that's the word we'll use. We'll actually say we're going to translate it, but we're just talking about the conversion process. We're going to convert it using the translation method, which is what I would have expected it to be. End of discussion. This is what I would have expected. Current rates at the balance sheet date, average rates for the income statement, and you're done. Then, according to the way I'm looking at it, you come along and say, well, what if this side, this number one side of the equation, what if that's not what we've got? What if we really have something different? And what different is we have a parent corporation, U.S., but now the foreign subsidiary is really just an extension of the United States company. In fact, they may be doing so much transactions in U.S. dollars that get sent over during the course of the year that maybe U.S. dollars are getting sent over to this entity every day of the year to do business. And maybe the foreign corporation here that's a subsidiary of the parent doesn't have its own management team. Maybe it's managed by U.S. employees. Maybe it doesn't even have its own production factory or sales force. It's certainly the opposite of self-contained. And its functional currency can't be seen as being the local currency, as it was here in case number one. It can't be seen as the local currency, even if when the dollars get sent over to the foreign subsidiary, they're being converted immediately into the foreign currency in order to do business there. It's really the United States dollar that is running the show. It doesn't have to be being sent over there every day. It could be once a week, once a month. But it's really the U.S. dollars that are running the show. In fact, in some cases, the FASB writes, in some cases, the currency on the financial statement is the local currency of the country that the foreign subsidiary is in. But in many other cases, there's so many dollars flowing back and forth that the foreign subsidiary decides to report in U.S. dollars. So the financial statement that the parent picks up is already denominated in U.S. dollars, not a foreign currency. And that's a situation where you don't do translation as your method of converting, but you do something called remeasurement. And that's where we need to see the difference between this scenario here, where we see everything's done what we would normally think, just do it at the balance sheet date. Now we need to see a different methodology where it's going to be called remeasurement, as we've said. And the reason is that it's not just simply a translation, is because they're not functioning in that foreign currency. They're really functioning in U.S. dollars and just perhaps reporting, as we saw in this A situation, in the local currency. Sometimes reporting into U.S. dollars. Whichever way it does report the foreign subsidiary, in this case, this number 2 case over here, whichever way it's reporting, we look at their financial statement and we say, all right, we're not going to convert by translating, simple translating. We're going to do what we call remeasurement, and remeasurement will be saying, okay, so let's figure out what the whole deal is in terms of foreign exposure to or exposure to the foreign currency exchange rates, let's take a look at it from the reality of it's a U.S. company. Where is the U.S. company running the risk of being in the foreign currency exchange market? Well, you have to say for sure, you would have to say for sure that's with cash and other monetary assets and liabilities, which we discussed and said that means basically AR and AP. Could be some other types of similar accounts, but those are the main monetary items. Whereas so at 12/31, balance sheet date 16, we'd want to know how to convert those. We'd convert them based on the exchange rate that day, because that's what it's going to mean to us when we get paid off the AR in foreign currency. It's going to be exchanged into that spot rate's exchange rate. So these assets and liabilities are all at running the risk of the foreign currency exchange market. So here, in this part of our discussion, we would say all these assets and liabilities would get converted using the current rate. Exactly similar to what we would do for translation. No difference. However, when it comes to remeasurement again, and we're looking at other assets that are really extensions of the parent's assets, because that's the nature of the subsidiary. It's not self-contained. So when these assets and other liabilities that are long-term, meaning mostly fixed assets, prepaids, other assets, long-term liabilities, etc., in all these areas, these are really just extensions to the parent. How would the parent report it on his financial statement? It would have reported it using the historical dollar at the day that they used the dollar to exchange into the foreign currency to buy these assets, to incur these liabilities, etc. Could also include prepaids, by the way. And so here, in this case, what we're trying to do is just mimic what we would be doing if the foreign subsidiary was a U.S. corporation to begin with. If it was a U.S. corporation to begin with, the only things that would get converted into U.S. dollars would be cash that's in the foreign currency, AR that's in the foreign currency, AP that's in the foreign currency. Those things would get converted using current rates, whereas everything else would have been reported at historical U.S. dollar rates if this was nothing more than the U.S. company extending itself into the foreign country. Well, that's my theory. I don't know if it made sense to you, but it explains this picture, that on issue number 1, we used the translation method, where just about everything is on a current exchange rate at balance sheet date, and the income statement is done on a average rate during the year, and it explains, or at least it tries to explain, this case where it's not a self-sufficient entity, the subsidiary, where assets and liabilities are often done on historical rates, except if they are definitely exposed, if they're monetary assets and liabilities exposed to the current exchange rate fluctuation, and therefore we're going to report those items in historical cost. On the income statement, it'll be average, except for items where historical cost makes sense, like inventory and depreciation and amortization. That's the theory. Of course, in all cases, the common stock, the paid in capital, is translated at historical exchange rates, as we discussed the other day. Does this help? Don't answer that question where I can hear it. Okay.